When you raise a fund, somebody is giving you power of attorney on their capital until it's fully invested. When you go out to find capital for a deal, an investor is making a decision based on the price and the deal that you've structured, and they're probably negotiating a little bit as well. So when someone gives you discretion, you have to earn their trust.
Right now in America, the real estate capital markets are, they're not what they have been for, let's call it the last 15 years. And I thought that would be a good place to start. You are at the intersection of what's going on in the capital markets. And so I'll ask it broadly, but kind of where do you see things right now? What's going on from your perspective? We can talk debt, equity, asset classes. We can take this wherever you'd like.
Sure. Well, it's been a tough year for real estate. I mean, you could say we're in a real estate depression. I was a little amused when I was reading my newsfeed this morning, and one of the macro pundits said, real estate's the next bubble to burst. And I was like, is that a news flash? Where have you been? He's talking about commercial real estate, obviously. So, and I've done this for over 30 years at this point. So I think this is my fourth cycle. It is as deep and as bad as any cycle that I've lived through. Different, obviously, and we can talk about how. It's not just macroeconomic, like the S&L crisis was, like the tech bubble was, even like the GFC. But there's some secular changes in the way we're using real estate. Obviously, what's happened with office, that's changing it. But the biggest thing about real estate, from our perspective, which is the perspective of an investor, a long-term investor in the asset class, is that so much of it, depends upon where valuations are, and appraisals are a really important part of that as well, because there's an embedded enormous portfolio in institutions who broadly started investing in real estate as an asset class in the 1980s, some 40 years later have huge portfolios, and they're getting written down very, very slowly. So it's a melting ice cube, and it's melting much more slowly than any of the other capital markets. If you look, for example, at the publicly traded REITs, they're down today. They're trading at an sort of implied cap rate, and this is obviously broad strokes, of about 6%. They're down, probably twice the level that real estate is down, in terms of its appraised values. But so they're down maybe 36%, depending upon what date you want to use. We're down 17, 18% in appraised values, depending upon which metric you're using. But we know that that's probably, 6% is probably too low an average cap rate because it's still negative leverage. And so we know we are less than halfway there. So it's just a very slow, torturous process to revalue the asset class. And given how quickly interest rates, it's all interest rate driven, right? Obviously, because of the Fed's response to trying to control inflation has been to raise interest rates faster than we've seen in 2 decades. And so as a result, values decline because generally roughly half of commercial real estate's bought with debt. So the cost of debt's gone up dramatically. The cost of equity has to readjust, and nobody really has a confidence level yet. Maybe the last week or two, people are starting to feel that interest rates have leveled out and the Fed's no longer going to raise. And that's a little bit of a cause for optimism. But it really depends if we have a soft landing, which, the Wall Street Journal declared last week. But I don't think anybody's fully betting on that yet, except for the equity markets. So when you have an illiquid asset class that you're going to have to hold for a very long time, it just takes a long time to revalue. And that's probably going to go on for at least another year. And everybody got so used to these rapid cycles, and particularly with COVID, where people thought, oh my gosh, it's terrible, and we're going to have a big adjustment. And, 2 months later, we were flooded with capital, and we did not have that big adjustment. So there's an expectation on the part of many folks in the industry who haven't been around for that long that this would be a short cycle and it's going to be a lot longer than people think. That's our view. And the uncertainty is just causing people to, when in doubt, do nothing. And that is a mantra, frankly, of the institutional business. So things aren't trading. Transaction volume is down probably 80%. And nobody has a real sense of confidence as to where they should trade. So that's why you see, everybody's latest darling is something like Pref equity, where you can fudge it, right? You're higher in the capital stack. If the values go down, you're still okay. You're getting some current yield. And so everybody wants Pref equity today, but that's just a hedge.
Oh man, you said so much there.
I know. Sorry.
No,
I just went on and on.
I love it. I'm going to pick this apart. So, first off, when you say long cycle versus short cycle, is your definition of long cycle the time it takes to kind of hit bottom and then come back up? Like, what do you mean by long cycle?
Yes, it's the amount of time. If you're at a value, let's say you buy something for 100 and then values decline, it's how long it takes for you to recoup your 100 to get back to your cost basis, if you will. One of the things about real estate is it initially was part of institutional portfolios viewed for three reasons, right? This was the classic asset allocation theory: income, diversification, and less volatile than equities and other asset classes. So you never want to lose principal with real estate, and that's probably the first credo of any institutional investors: don't lose principal.
You said we're less than halfway there. Are we less than halfway to bottom, or what are we less than halfway to?
When I said that, I was just using as a proxy the decline in appraised values for, say, the Odyssey, which is the open-end fund index, and relative to, say, NAREIT, which is NACREIF, NAREIT, which is the public markets. So the public markets are down twice as much as the private markets in terms of valuation. And you could argue that they're not yet down enough. So, by the way, every time I say all these things, I'm thinking this is all true if you're investing in indexes. But most of us don't invest in indexes, right? We buy properties. We buy property types. We buy specific situations. The beauty about real estate is it special sits in people. Okay, now we should talk about that later, where this is true and where it's not true. But generally speaking, if we've been at this decline for about a year and a quarter, it's at least another year before we've hit bottom. And then how quickly do we come back? So much of it's a function of what happens to interest rates and what happens to the economy.
Again, we don't know what's going to happen an hour from now, but let's say that things are kind of stabilizing and that interest rates really aren't going to go up much further. Do you think this is you've kind of alluded to it, like, let's just sit and wait and let it keep working its way through the system, maybe for another year before you start seeing a pickup in transactions?
So you have to say what's going to cause things to change, and what's going to cause things to move is debt coming due and major transaction volume. So I think in past cycles, when we've seen major bank loan sales, that's been new market makers, and people use those as metrics. Signature Bank's big loan sale is going to come up shortly here, and I think that will be an interesting metric for people. And you've probably seen a lot of data which talks about the flood of loans that are coming due. So what's happening today is that groups who took out floating rate loans that are coming due this year, next year, I think next year's a peak year, they're going to need some what's called gap equity, because they bought here, they borrowed here, values have come down, the loan to value won't change, and the interest cost is going to go up. So the coverage is going to go up. So they'll need an equity slug, and either they'll be able to get that through pref equity or mezzanine debt, or the bank will have to take back the assets. The bank really doesn't want to take back assets. They've kind of learned that lesson. But those will be the catalysts for things repricing in the market.
I think you answered the second question then, which is banks taking back. Do you think this is a cycle where actually not a lot will transact? The transaction will just happen within the capital stack rather than ownership changes?
Good question. I don't know the answer to it really. I think that there are certainly office owners today that they'll be very happy to just give back the assets because I mean, one of the rules I learned, I remember this early on in my career, was the 80-20 rule that when you have an institutional investor and you have a problem, what happens is at the board meetings, 80% of this time is spent dealing with 20% of the assets. And so there will be, and you've seen major important institutional investors hand back the keys on office buildings in particular, where they feel that the value is below the debt today. And they just don't want to spend the time figuring it out because they don't see the upside. So I think it just depends on what it is and where it is. But there's definitely going to be a flood of, in multifamily and in industrial, you'll see a lot of preferred equity. It's interesting. We have a transaction that we're about to come to market with. And the number of people who say they're interested because it's pref equity is staggering. We'll see how it prices, but pref equity is probably pricing in the mid-teens today. And that's a pretty attractive return to people.
That's the flavor of the day on industrial. Do you see it being on like new development that's coming to market, or where do you see pref equity fitting into the industrial side of things? I'm an industrial guy. I got to pick your brain here.
I know. I was going to say it's not on your properties, Chris, but I think that new property, rents have still been going up in industrial, obviously in Class A industrial. And I think even, you know better than I, in Class B industrial. So we're still seeing strong rental growth and ability to rent these assets up. And so I think probably you don't need the pref equity on new development. I don't think you'll see as much of this, generally speaking, in industrial, unless you have somebody who really over-levered a property. You'll see it more. You'll definitely see it in multifamily, because multifamily, when it was trading at 3.5 caps, when you go to and multifamily debt was plentiful at very low rates. And while relative to other property types, it's still plentiful because of agency debt, it's twice as expensive. So I think, and also it's such a big asset class, and there's so many non-institutional owners of multifamily. I think you'll see a lot more opportunity in the multifamily space.
You get to sit at the forefront of people that have ideas to raise funds or JVs, or they have some idea. And I want to go back to office. Have you seen, is anybody trying to raise distressed office funds or have some angle on office, or even those folks saying like, we just don't want any part of this mess at any price?
Yeah. One handful of folks are looking to do something in the office space, and the majority of them are looking to do office to residential conversions. So in the central business districts, they're very hard to do. They're expensive. It's good if you have experience. We have seen, a couple of successful JV raises or club vehicle raises there. And we've seen, interesting one-off transactions. I'd say we probably have talked to, out of the 2,000 investors we cover, I'm aware of, count them, 2 that say they want to do office as a distressed play. I'm sure there will be more, but it's just like that's a Monday morning conversation. Everybody's going, what? Really? That's so interesting. We are seeing, for example, we have a manager whom we work with who's buying office parks in suburban areas that have great locations, and literally moving the tenants from one building to the next as they sell off the rest of the parcels for single family rental development because it's zoned for resi. So if you can, find a multiple use, and he calls it, taking the melting ice cube, and as the tenants leave, you just kind of move them to one corner of the parcel. That's an interesting play, and you can do that unlevered and make a 2x. So there are specific strategies, but I think Look, I am literally standing in my office watching the most spectacular construction of the J.P. Morgan building, which is north of. I'm on 41. I think it's 70 something stories, and it's literally when I first. It was a hole in the ground a couple of years ago. I've watched the whole thing go up, and it's a beautiful building. Will they fill it up, and will it really be a spectacular kind of fulcrum for the organization? Absolutely. So, I think if you're in New York City and you want to be between 42nd Street and 61st Street, within a couple of blocks of Park Avenue, you're paying up for rent right now, because this is the 100% location and it still exists. But there are a lot of mid-block B buildings that are going to go, they're definitely not being able to command much rent.
You think those are going to go to resi, or is it just going to trade at land value, and we're just going to see a lot of stuff start coming down as it relates to New York specific?
Well, I think it's location specific. So you saw in the last cycle, a lot of Wall Street older office buildings convert to resi. So a lot of people now live in the financial district in these converted buildings, and they love it. And some of them are crazy expensive. Personally, it's not my cup of tea. But I think if you're in the right location, it absolutely can be successful. I mean, in New York, you have some cavernous buildings on 6th Avenue. I think would be very hard to convert. You have some smaller buildings on 3rd Avenue. You could probably convert some of them. But it's the doom cycle that everybody talks about. So you have people stop coming to the office, and then you have people move out of the city, and you have lower tax revenues. And so then you have homeless issues. And then the government comes in and raises taxes to try to increase the services, and more people move out. So it's this kind of doom loop that we've seen in many of the cities, not Dallas, and not in the South as much. But we have got to figure out how to fight that. I'm a born and bred New Yorker, so I will never, ever, ever bet against this city. It'll be fine. We'll be back. But, I grew up on Avenue C and 21st Street. It's a little bit of a, wasteland today, but for sure where Chelsea Piers is was much more of a wasteland. And, that's where you went to do things you really weren't supposed to do. And if you look at the West Side today, it's mind blowing how beautiful it is. So things will cycle.
So basically, capital's like sitting on the sideline right now. Are the institutional capital? There's family offices. There's sovereign wealth. Are any of those buckets maybe moving more than others, or is pretty much everybody kind of silent right now?
Well, one of the many things I love about our role in the real estate business is there's always something to do. And so we've actually been pretty busy working in niche sectors, some of which are, offshoots of the industrial space, and been quite successful in them even raising capital for them this year. So, and we've raised capital from pretty much every category of investor. So it's not that people are doing nothing. They're, I'd say, institutional investors. If on average, the big public pension plans, let's say, invested, on a scale of 100 last year to this year, they're probably at 35%. So they just scaled back their allocation because they were over allocated. There was, as a result of, portfolio, the equity markets had come down. Obviously, the fixed income portfolio value had come way down, and their real estate portfolio hadn't been revalued as quickly. With the equity markets coming back, there's hope that the portfolio allocations will increase next year. And I think they will to some extent. So we won't be at 35%, but we'll be at something high. We won't be at 100, but we'll be somewhere in between. So public pension funds are still investing, but at a lower rate. Endowments and foundations are still investing. Some of the sovereigns are very active and some are very quiet. Interesting, but a little bit of a dichotomy there. We've seen more capital or more interest from the Middle East this year than probably we've seen in many years. And obviously oil prices coming back and diversification and what's happened in Saudi Arabia, all those things are contributing factors. And we continue to see money coming here from Asia, slowly, but coming, maybe less so from Europe or Latin America at the moment.
What do institutional investors care about as it relates to, or in contrast to like private investors, like family offices? They care more about allocation and portfolio construct. Like, are there key differences in how institutional investors look at the world as opposed to an ultra high net worth or a family office or a sovereign, that aren't necessarily deal related, but more like allocation related? They want exposure to things.
And again, in the category of all generalizations are false. Generally speaking, if you're a CIO of a large public pension plan, you're managing to a target return. Maybe that's 7%. And so you're looking at the diversification within your portfolio to manage to that over a longer period of time. And you have a consultant that's giving you sort of an allocation mix, and you manage your real estate to hit that target. And that's really important. And it's interesting because if you look at many of the studies that have been done about return, most of the differential in return is not by manager, but by property type or region. So if you get that broadly right, you are going to outperform indexes. I mean, as an example, if you look at where the Odyssey 1-year index traded right now, it traded down round numbers, 10%. But industrial is only down 7%, and office is down about 20%. So if you were just been in office, you'd be down 20. If you were just in industrial, you're down 7. That's that's a big difference. So you want to get the property types right. And when you look at differentials of managers, the ones that have gotten that right tend to be able to raise more capital over time. And they're really not necessarily institutional investors, like large institutional investors. They get paid not to make big mistakes. They don't get paid to outperform. That is distinctly different than someone managing a foundation or certainly managing a family office, where foundations typically have a much higher hurdle rate for real estate. So they're looking at it often to compete with private equity, which means a 20% return and a 2x, which is super hard to do, as you know, in real estate. And in family offices may have a lot of real estate that's not even in their investment portfolio. So if they're looking for it at all, they're looking for outperformance typically, because they feel they have the diversification of homes, or even though you can argue that that's not going to perform the same way, they're not necessarily looking to real estate to generate a certain type of return. So when we talk to foundations, endowments, family offices, we're typically offering them much higher return opportunities. And some of those groups are much more focused on multiple, because they really don't want to have to keep, you can't eat IRR, right? So they're really looking for a 2 or 2.5x. And they also want the tax, there's an obvious difference is whether you're taxable or tax exempt. So if you're a taxable investor, every time you sell an asset and you pay your tax and you reinvest, you're worse off than if you had just held it for a long period of time, and the power of compounding allowed you to grow your equity multiple even higher. So taxable investors tend to like a longer hold period and something that would be more tax efficient.
Okay, so if a deal was producing, let's just call it a 20 over 5, or we believed that it might, that just naturally, I'm not saying it wouldn't be a fit for institutional, but since they're probably looking to take less risk and lower return, would you show that deal to an institution, or that immediately goes to family offices and endowments based on the risk profile?
Oh, we would show it for sure. It depends what it is. If it's a development deal of an environmentally tainted site, and you're buying the land and then you're going for a cleanup, we know an institutional investor is not going to do that. But if it's, if it's just, a distressed debt play, sure.
I'm assuming the development cycle is going to be a lot longer than, call it, the normal cycle, meaning the first money in will probably be acquiring existing assets at discounts, as it takes longer for ground up deals to kind of pencil. Is that what you're thinking?
Are you talking about in this cycle or just generally speaking?
It just seems like the development valuations are getting everything to work with construction cost up, interest rates, price of land is so upside down right now that money into new development might take a little bit longer than maybe money into the first assets that start trading. Does that make sense?
Well, it does conceptually, but I'm thinking about two development projects or two development strategies that we're working on that make more sense today than they did a year ago, for sure. They make more sense today because land values are down. I mean, you can probably buy the land for 20 or 25 cents on the dollar of what you could have bought at, a year or two ago. So even if land is only 15% of your cost, that's material. And then inflation's mitigated. So we're hearing from folks who are, in the construction business, materials prices are certainly not going up the same way they were. And even if they've stayed a little bit higher, because there's no development going on, labor costs are way down. So that contractors just want to keep their teams employed. So you can get a guaranteed max price contract with the labor at a way cheaper rate because there's not a lot of work to go around, supply demand. So we're seeing some really interesting, and particularly in sectors that need development. So build to rent is a really interesting sector that we're seeing a lot of activity in. I think 14,000 build to rent homes were delivered last year compared to like 1.5 million single family homes. There's just not a lot of scaled purpose-built build to rent, and people want it. So will it be able to continue to, there was an article actually in the paper today about how rental prices have stayed high on homes. Will you still be able to rent those that are yield on cost that makes new development make sense? I think so. So again, it depends what you're doing, but unless you're JP Morgan and you've planned this for a very long time, is anyone building a new office building today? Probably not.
Are any unique structures kind of showing themselves as people are raising right now, like raising in ways that you haven't seen before? Or is it all pretty much still down the middle of the fairway, typical raises?
That's a great question. I mean, the concepts du jour, if you will, are disintermediating the GP. So many investors now want to own a piece of the general partner so that they share in the fees and the promote, and they're willing to take more risk in funding some operating expenses or going in and buying out an older partner and buying into an operating company. So we're seeing more of that activity and interest. And then the other, big, we've talked about pref equity, but the other thing that you'll see a lot of is secondary trading. We haven't seen a lot of secondary trades happen yet, again, because of valuation, but we're working on a couple. And once values are more known, I think we'll see more secondary trades. And then GP-led recaps will become, I think, something that's much more accepted in the business. So we've done a few of them. I think you'll see a lot more. And what that is when you have an operator or general partner or an investment manager who controls a fund and some of those assets, and the fund is coming to its end of its useful life or it's running out of capital, there's a need to bring in new investors and more capital. And as part of that, you may offer to buy out do a tender and offer to buy out existing investors. More often than not, you'll take the pool of assets and put them in a new structure and recapitalize that structure with a longer tail life so that whatever the value add proposition was, there'll be time to do it and capital to do it. And we're very focused on that business. That's a big part of what we're seeing right now. And I think that will be more and more interesting to investors as well.
Okay, I'm just going to ask a dumb question. Why is that called a GP-led recap? Meaning the bunch of assets, GP doesn't necessarily want to sell them, wants to keep working on them or holding them. They come to you as the GP and they lead an opportunity to recap. And I'm assuming they've already told their LPs prior to engaging with you or some firm that, hey, we're going to go recap this and LPs have given the thumbs up, assuming that valuation is intact or everybody can agree on valuation?
There are a lot of steps to making this happen. And obviously there are fairness opinions, and there's a lot of things that you need to do to make sure that as a fiduciary, if you're the GP, you've done the right thing by your existing investors. So that's a whole other conversation. But as a GP-led recap, as opposed to an LP-led recap, because the GP is making the decision for the investors that they want to recapitalize that portfolio or those assets. Whereas if an investor says, I had this conversation the other day, we just took over this portfolio. There's a bunch of assets, a bunch of fund investments in here. It's not really what we want to do. They'll just put those on the market as a secondary. So in that case, somebody comes into the LP position, no incremental controls, nothing to do with, which assets get to stay in or stay out. Basically, you're just replacing one LP limited partner for another with the same subscription documents, the same partnership agreements, the same structure. And it's just a question of, does it trade at net asset value or at some discount or premium to that net asset value?
Why is that in vogue right now more than in other times? Why is that like the flavor of the day right now?
The GP-led recaps, or because so many investments portfolios are either have been financed with floating rate debt. And so when the debt comes up, they're going to need more capital and they didn't plan properly for it. But the assets, there's no transaction volume. So if you want to sell an asset today, you are probably going to have to take a haircut to what you really feel the value is, just because people are nervous to buy anything. So it's a bad time to sell. You may be better off getting, recapitalizing it, and maybe with pref equity or with mezzanine or just with new investors. And the existing investors may feel like, well, I don't want to sell at that price. I'm happy to stay in and let this manager continue to do what I hired them to do in the first place. So it's largely a function of debt and also lack of transaction volume.
Going back real quick on LPs wanting a piece of the GP. How should GPs be thinking about this? And let's say they're going out to raise money, and through that process, and we're going to talk about first-time funds in a bit. It would be not good of me to have this conversation with you publicly, knowing that I'm probably in one of those camps. But before we go there, if I said, what work would a GP do, or what should they know about if they meet an LP and the LP says, great, I love your deal, I actually want to own a piece of you too. Like, what kind of matters as to, one, how that LP or that investor is going to value the GP, and what should the GP maybe have done or pre-work that they should have thought about before they get asked that question?
Well, the number one issue is, what controls are you willing to give up? So are you just looking for capital and you want to keep everything as it is? Maybe if you sell a 10% interest, you can do that. But if you're looking to buy out a partner, or you need a lot of capital, it's what level of control this investor would have in your business. And then, who is the investor? How do they operate? Are the people that you're sitting across the table from likely to be there in 2 years, because you're going to be there in 2 years? What's their board process? Do they have allergies? Like you asked the question a while ago about the difference between institutional investors and, say, high net worth. Headline risk. Some institutional investors have a real issue with respect to headline risk, and others don't. So how, are you compatible in all those different ways? And it's really hard to have a checklist. I've been doing this a long time. Like, you just kind of sit down and you'll know, or you hopefully will know. You won't always know. I've actually, look, it's like life. You learn by making mistakes. And the things that the things that you thought were going to happen didn't happen. The next time you'll make different mistakes. So it is a very hard thing, though, because if you're just selling an asset or you're selling a portfolio, So it's an asset, it's a portfolio, it's very reproducible. Selling a piece of your business is super hard. And it's not just the valuation. It's really about, that's your livelihood. It's your culture. All those things are so challenging. The reason that most people ultimately will make this trade is because that investor is going to bring what we would call limited partner capital to them, or LP capital. So there are lots and lots of folks who could come in and buy X percentage of your operating company, but how many of them can give you $500 million to invest as well? And that's when we tend to see investors, operators being willing to make that trade, because they grow your business at a level that you wouldn't be able to grow it, or it would take you so much longer to grow it on your own.
And when they make those investments, are they usually, let's say, first engagement, they're buying a piece of the operating company? And I know this is just a very generalized question, and the answer is it's deal by deal, but are they usually looking to take like a smaller piece of the GP with some contract that they can continue to buy more and grow, or a small piece with a way to get out of it over time? Like, how are those usually structured? I'm assuming it's not just this good faith, like we're here forever. There's usually maybe some mechanism one way or the other.
Well, it depends when and why you did the deal. If you do the deal initially to get started, so let's say you sell a 20% interest in the business and they're going to give you $100 million to seed each of your next 3 funds. So that that once this business is up and running, you will now you'll have assets, you'll want the ability to buy that investor back. And they may well be willing to do that. So you probably have some kind of a buy-sell mechanism at some point in time, either based on your AUM or based on time or based on the number of funds that you've raised, something like that. If you're doing it to buy out a partner and it's not clear, you don't clearly have a timeline, you may just be willing to do it. You'll always have some kind of a buy-sell mechanism, but it may not be as time constricted. So, there's probably 5 or 6 large firms that do this all day long. I mean, they raise capital to do this. And when they raise capital, they typically raise it in a private equity format. So if you're investing in a fund that goes and buys GP stakes, that's like a 7-year fund. So whoever that group is doing a deal with knows that in 7 years, they're going to be sold again. And you see a lot. Now we've lived through probably 2 or 3 cycles of that. And, it's, if you're in that position, come talk to us, because it's interesting to see what people learn over time. It's extremely, if we, Park Madison Partners as a placement firm, are approached by a group that has just sold an interest in their business or a majority interest in their business, it's very hard for us to raise LP capital around that, because investors are like, I want to see how this settles. I want to see who stays and goes. I want to see what happens to compensation. I want to see who's really making the decision. One of the things about our business that I just love, but is really hard and has taken years to learn, is our job is not just to find the best product and managers, but to figure out how the decisions are made in the firm. And that's like seeing through the spaces, right? And it's Warren Buffett. When the tide goes out, you learn who's not wearing a bathing suit. So, he said it differently, but the point being that
you see who's swimming naked.
Yes, that's true. But the point being that you have to see in the spaces of how decisions are made. And it's really hard to figure out when you're just sitting on the other side of the table as an investor. And when there's a change of control, or even when there's a new investor, that's somewhat disruptive to that process. And investors want to watch it settle before they make a commitment. Because once you're invested in these funds, you're locked up for 5 or 10 years. And all you have, as one of our investors said, is whining power. So you can't really vote with your feet, unlike the public markets.
The reason why you would do it is you need more capital to grow your business. and B, maybe they're bringing something to the table, whether it's connections or insights or something that is a value add to the company. Is there any other reasons that aren't coming to mind of why selling a piece of the GP matters, or is it usually to open up capital opportunities and to maybe add a different strategy or insights or network that didn't exist before?
Yeah, I think that's generally it. I mean, again, you might need capital to buy out a partner.
And as the way it's valued, do they value any of the existing promote that might exist in the existing portfolio, or like how do they come to valuation on this? Is it a multiple of EBITDA at the operating company plus promotes, or what's generally the formula?
Yeah, it's so interesting, and obviously this is cyclical. But, at the top of the last cycle when valuations were quite lofty, and, Chris, you'll live to see this again, it's a multiple of EBITDA. So it's your fee income. And typically, new buyers have allowed the partners to keep the promotes from the existing funds in full. So they're essentially buying the future. And so that's, if especially if you've had good success, it's pretty darn attractive.
I hope to live to see another market top. That was fun.
I have no doubt you will, Chris. You'll be here before you know it.
All right. So there's a lot of folks, and I'll put myself in this category, but I know a lot of people right now. We've syndicated for 18 years. And there's a lot of people going into this next cycle that are thinking, man, having pre-committed capital, maybe raising our first fund, doesn't really matter the structure, but going into this thinking we're going to change our business model. You guys have done over 14 first-time funds. And so I wanted to just spend a little time, maybe some wisdom that you would share on if this is a route you're wanting to take. Here might be some things to think about when doing this. I think there's a lot of people that'll get value from this.
I know whenever anybody asks me for wisdom, I feel extremely humble. I think the biggest considerations when you think about raising funds versus going deal by deal or portfolio by portfolio is the cross. And so now you're crossing all your deals, and you're crossing all your promotes, and it totally changes the timing arc of how you get paid. So if you are raising a fund, it might take a year to raise it. You'll have a 2 to 3 year investment period, and you'll probably have a 5 to 8 year holding period. So, and then you only earn a promote after you've returned all the capital plus a pref. So realistically, even in a super hot market, you're 5 years in, and you could be longer than that. And by crossing your promotes, I had a real privilege last year of going to the Berkshire Hathaway annual meeting. And I mean, I just sat there and I just tried to soak up some of the unbelievable wisdom and, scribbling different notes and things. And Warren Buffett made the comment, which I really didn't appreciate, although my son who came with me said, Mom, you said that before. But, what do I know? He said he's the beneficiary of having made one really good decision every 5 years. You can think about Apple stock, right? It's been like a great performer for them. And I thought to myself, if I did that, I would have been out of business so long ago. Because as a placement firm, and I think as an investment management firm in the real estate business, you have to be in the business of hitting singles and doubles. And every so often you'll hit a triple or a homer, and that's great. And that'll be your outperformer. But you can't afford donuts or fly balls. And it just, if you think about having a fund and having your promotes all be crossed and you lose the capital on one deal, you've just worked for 3 years for no promote. So that's the bargain, if you will, of having discretionary capital. But it's really important as a firm to have a process where you feel comfortable that your process will allow the full team to be in consensus on making these investment decisions. Because You get one, you get a pop out, and then you really are in trouble for a long time. So what you're going to see, and then sometimes the market just like this shift. Very few people. So I'm sure some people will look back a few years from now and say, "Oh, I predicted the rise in rates, and I was so smart." But people didn't really predict this, and at least not this fast. And so what you'll see as a result of just this incredible transition in values is there'll be probably as big a morphing of the investment management business. So many mid-sized firms will lose their talented bench because people will go out and start new businesses. It's a great opportunity to start investing de novo, to be able to go out without a legacy portfolio. We talked about the 80-20 rule, and they've lost their promotes. So there's really no reason to stick around. You're sticking around for salary and bonus, which is not why many talented people in this industry, they want to be on the equity side of the balance sheet. So you'll see a lot of new firms start, whether they end up becoming large investment management firms or more just operators doing interesting deals. And so we have all these other structures that aren't funds that we work with now, whether they're JVs or development platforms or co-investment vehicles. But if you're a manager, if you're an operator, there's a lot of other ways to raise capital that can be more programmatic than just a fund structure, where you can have some more flexibility on the crosses.
One of those would be like a GP style fund where you don't actually have to cross everything. Correct? I mean, I don't even know if I guess that's a type of fund, but it's a totally different characteristic where the main.
Well, you would cross in the GP fund, but you wouldn't cross once you've taken down a deal with the GP fund, and then you go out to raise the equity. That investor can be bespoke because they've chosen that investment, and they don't cross.
I think you hit on a really key part there, which was lack of incentives to want to keep working on a fund or deals because the upside's not out there. Do y'all work on anything where an existing fund manager might come to you and say, we got to restructure these documents or this fund to motivate our staff to want to keep working on this? Or does the fund usually just play out, people leave, and you hire more people to fight another day?
So groups come to us all the time and ask us that. And then our job is to say, because our job as a placement firm is we're the bridge. We're representing we're hired by the manager, but we're representing the investors. And the reason we're successful at what we do is because investors know us and trust us. And that is front and center of every decision that we make. So we're looking at this fund and saying, okay, like this happened. We were working on something like this not long ago. They are out of the promote, but they have done a good job. COVID wasn't kind. And as a result, would like to restructure the fund, allow investors who want to exit at the current pricing, and then find new investors to come in at a value where there will be some new promote to keep the team together. And that's the premise. So yes, that can work. You need to have true faith that the manager is the right manager for that portfolio. And you probably need to offer existing investors the choice to exit if they want to exit.
Real quick on finishing kind of the fund discussion. If you're raising your 10th fund, you're probably being looked at differently than if you're raising your first. Just in going through the last year, it's like, okay, even though we've syndicated hundreds of millions of dollars, the narrative's always like, but this is your first fund. Why is it that sometimes a track record of different ways of raising money doesn't necessarily always translate to you're ready for a fund? Like, why is that? Why does there seem to be this this gap that always has to be bridged?
One word: discretion. When you raise a fund, somebody is giving you power of attorney on their capital until it's fully invested. When you go out to find capital for a deal, and an investor is making a decision based on the price and the deal that you've structured, and they're probably negotiating a little bit as well. So when someone gives you discretion, you have to earn their trust. And that's And therein lies the difference.
I learned something new today. For that I will not forget that. That was drilled home. You talked about other structures.
You make me sound like a school marm.
No.
Oh my gosh.
Look, maybe I have heard it in meetings and it didn't really register, but that for some reason that registered. I will not forget that. I'm a one-word kind of guy. The fewer words, the more simple that we say them, the easier it is for me to understand. You talked about also just JVs, development platforms, separate accounts. Again, I'll use myself as an example. If you've been doing things one way forever and you've just been heads down and you're not necessarily privy to all the different platforms, is it through working with y'all or how should somebody think of this is the way we should raise money? Like what puts you in certain buckets as opposed to raising a fund? Why would one bucket be more beneficiary than the other?
If you want to be in the fund management business, you have to decide that you also want to be in the client service business. Fund management means you're a fiduciary to your clients, and you need to reorganize your staff to be responsive to those clients, for reporting, for answering their questions quickly. Probably as a senior, person at the firm, you need to make yourself available to those clients. So you've really changed. You've added a second group of people you have to report to, whereas and that are critical to the business in the same way that your tenants are critical to your business. And so if you think of yourself more as a real estate operator, then you would just want to find the cheapest source of capital at any given point in time. And capital's fungible. So you have the flexibility to operate your business that way because your job is to maximize the operating return from your real estate. That's a different business. Someone who's a good fund manager should have both characteristics. They have to be a great operator or allocator, depending upon what their strategy is, and they have to be a great fiduciary.
This isn't a loaded question. This is an honest question. Why would somebody want to be a fund manager?
Discretionary capital.
But you couldn't get discretionary if it was a JV or a separate account. Like none of those come with discretion. Those are always deal by deal.
Sometimes you can have discretion in a box, but if you have discretion in a box, then you're effectively you are a fiduciary as well. So there are different structures. You could have a programmatic JV, which is discretion in a box, meaning if the asset fits these size type parameters, then you can go and do it. Just have to inform your investor, but you don't need their explicit permission, but you are acting in a fiduciary capacity to them. And you probably will be crossing promotes then.
Is there a size or just like a characteristic that maybe early on in your career, being more of an operator that's taking on JV capital or, different structures make sense, but then maybe something's going on in your business where it's clear that you would make a move to more of a fund business? Or is that just total preference on the future of your company? It has nothing to do with size or scale?
It's a great question. And I think for me personally, as I look at my career path, I just knew a lot more fund managers. I didn't tend to know some of these large operators who found capital in different ways. But the truth is, businesses have grown in both ways. It's really about access to capital. You can be a great operator, build your portfolio in a variety of different ways, and then take it public. Now you're managing a public company. You could do, and if you look at the regional malls and a lot of the multifamily groups, they did that, and that's always an option, obviously with a different outcome. I think it's really about having the desire to be a fiduciary to investors and having those long-term trusted relationships. And that's when we often will have groups come in. I mean, we looked at 148 funds this year looking for a placement agent. Some of them were first time, some of them were existing managers. We did one.
Damn.
Yeah.
Why?
So, well, it's a host of reasons. Obviously, it's a challenging year to raise capital. So, today, in order to raise capital, you have to have a strategy that's really unique in a fund strategy, because there's enough existing managers who've had the wind at their back for the last 15 years, perform super well. So they're going to get re-ups from their existing clients, and finding new investors is super hard. But if you have a unique strategy that investors don't have in their portfolio, then they will find a new manager to do that. And they tend to be, more niche strategies, sort of on the outskirts of office, retail, and multi. So we've done those. I'd say technology and data centers and infrastructure, definitely something that's coming into investor portfolios that hasn't been there before. Those are new managers. But if you're an operator looking to do a capital transaction, our ratio of operators who've come to us and transactions that are actively pursuing or working on is probably 10%. So it's a much lower bar to do a capital transaction.
And if you're raising a fund and those initial investors are coming into fund one, I'm assuming their intent is, if we're willing to go into fund one, we're hoping to be investors in fund two, fund three, fund four. Do they even think that far out? Or is it, let's just get in fund one, see how it does, and then we'll talk again when fund two comes around? Or are they really thinking about that allocation as something they could be making over multiple funds?
Yeah, most investors are really understaffed, and they want to make a decision that will last for, 10 or 15 years. So they absolutely want to invest with the manager long term. Plus, it's awfully challenging to cover, many, many managers in your portfolio. Whereas when you have repeat funds with the same manager, it's just, you have one client conference to go to, one person to talk to. It's much easier. So that's always the goal. We have some investors who, when they make the commitment to the first fund, tell us they mentally allocate to the second fund, because you probably won't have enough realizations or any realizations from fund one before you have to go to fund two. So they think about it as a 2-fund commitment. That's pretty smart. I like that thinking. And we think about it as a 2-fund commitment, by the way. So when we work with a manager, we won't work with managers if we think it's, generally speaking, we won't do it something that's just a one and done. I mean, we did that in PPIP, Public-Private Investment Partnership, because it was a moment in time, and that was a special situation. But generally speaking, of the 14 first-time funds that we've done, we've almost always done the second and third funds.
How many folks think they want to become maybe what we'll call a fund business, where they're making, a series of funds, and then they kind of do their first one and they're like, this isn't for us? Or by the end of fund one, have you kind of the culture has changed, the structure, what people are doing has changed to where it only makes sense to raise that next fund? Assuming performance is there, do people often get through fund one and try and do something different, or that usually sets the course for the business going forward?
Yeah, not voluntarily. If fund one is a success, almost always there's a fund two and on. If fund one is a disaster, then that's not such a good thing. But you wouldn't, generally speaking, it's a little bit like having a child, right? You have created something, those long-term relationships, and the fund will last for so long, right? Even if you decide, you have to make that decision about fund two when you've invested the capital, and the infrastructure to manage fund one is now in place. If you don't have a fund two, you can't leverage that infrastructure. It doesn't make any sense.
All right, Nancy, that's a great place to bring it home. Thank you so much for today.
Thank you.